The wheel strategy is one of the most popular ways traders generate consistent income from the stock market. It's simple, it's repeatable, and today I'm going to show you exactly how it works, step by step.
At its core, the wheel is a four-phase cycle. 1. You sell a cash-secured put. 2. If the stock drops, you get assigned shares. 3. You sell a covered call against those shares. And 4. Your shares get called away. And then you start all over again. At every single step, you're collecting premium.
So why do traders love it? Because you can earn income whether the stock goes sideways, up, or even slightly down. It's a rules-based system, so you're never guessing on direction. Worst case, you end up owning shares of a company you already wanted at a discount. It's one of the safest ways to start selling options.
Before you begin, you need 3 things. First, enough cash to buy 100 shares at your put strike. That's the strike price times 100. Second, a quality stock, one you'd genuinely be happy to own long-term, not a risky gamble. And third, options approval from your broker. Level 1 or 2 covers everything the wheel needs.
Quick refresher. There are 2 building blocks. A put is the right to sell shares at a set strike price. When you sell a put, you're agreeing to buy shares if the price falls, and you're paid a premium up front. A call is the right to buy shares at the strike. When you sell a call against stock you own, you agree to sell at that strike, collecting premium along the way. The wheel is really just selling puts, then selling calls over and over.
Let's start turning the wheel. Phase 1. Sell a cash-secured put. Pick a quality stock, choose a strike below today's price, and sell a put there. You're paid a premium immediately. Then you set aside the cash to buy 100 shares in case you get assigned. That's why it's called cash-secured.
Here's a real example. Say a stock trades at $195. You sell the $190 put 35 days out and collect a premium of $1.20 per share. That's $120 in your pocket right now. If the stock stays above $190 at expiration, the put expires worthless and you keep every penny.
A few keys to picking a smart put. Target around a 0.30 delta. That's roughly a 70% chance the put expires worthless. Sell 30 to 45 days out, the sweet spot where time decay works hardest in your favor. Watch implied volatility. Higher IV means fatter premiums. And always avoid selling over an earnings report. A surprise can blow right through your strike.
Now, what if the stock drops below your strike? You get assigned. You buy 100 shares at the strike price. And that's okay. It was a stock you wanted anyway. Better yet, the premium you already collected lowers your real cost. Buy at $190, keep a $1.20 premium, and your effective cost basis is $188.80. Your true break-even is already below the market.
This is the single most important concept in the wheel, your running cost basis. Every premium you collect lowers what you actually paid for those shares. Buy at $190, then collect premium after premium, and your true cost keeps dropping. That number, not the purchase price, is your real break-even, and it's what keeps the whole strategy safe.
Phase 3. Now that you own 100 shares, you sell a covered call. Choose a strike above your cost basis and sell a call there. You collect another premium, income while you simply hold the stock. And if the shares get called away above your strike, you sell at a profit.
Back to our example. You own 100 shares at a cost basis of $188.80. You sell the $195 call and collect another $1.10, $110. If the stock rises and you're called away at $195, you book the premium plus a $620 gain on the shares. Then you start a fresh wheel.
Selling calls the right way.
Always keep your strike above your cost basis, so you're never forced to sell at a loss. Use the same rhythm as your puts, around 0.3 delta 30 to 45 days out. Let the shares get called away. That's a win, not a loss. And if the stock runs, you can roll the call to avoid selling too cheap.
That word, rolling. When a trade moves against you, don't panic. You roll it. Step 1, buy to close your current option. Step 2, sell to open a new one, further out in time or at a better strike. Step 3, aim to still take in a net credit. Rolling buys you time and keeps premium flowing.
Phase 4. Your shares are called away at a profit, and you've pocketed every premium along the way. The put premium, the call premiums, and the gain on the shares. Now the position is closed, your cash is free, and the wheel is ready to spin again.
Let's put one full turn together. You sold the put for $120. You were assigned 100 shares at $190. You sold a covered call for $110. You were called away at $195, a $500 gain on the shares. Added up, about $850 of profit, roughly a 4.5% return in about a month. And now you go again.
Now the pitfalls, because the wheel only works if you avoid these. Don't wheel low-quality stocks just for fat premiums. That's how you end up bag holding. Never sell a call below your cost basis. Always check the calendar for earnings and news. Don't overcommit your capital to one position. Don't panic when you get assigned. It's part of the plan. And never lose track of your true cost basis.
That last point leads to risk management. Size every position so no single trade can seriously hurt you. Diversify across a few quality names instead of one big bet. Keep some cash in reserve so you can roll or seize opportunities. And always know your exit plan before you open the trade.
Now, keeping track of all this by hand gets messy fast. And that's exactly why we built Wheel Option Workshop. Every trade is tracked automatically, from cash-secured put to assignment to covered call. You always know which phase you're in, your effective cost, and what to do next.
Every entry is journaled with a single click. Puts, assignments, rolls, and profits, so you never lose the thread of a trade. Your full history, organized and searchable.
And it all rolls up into one dashboard. Your account value, premiums collected, and win rate at a glance. Plus a full education center that walks you through every concept we covered today.
So if you're ready to start turning the wheel, head to wheeloptionworkshop.com. Track your cost basis, your phases, and your premiums, and learn every step along the way. Start free and unlock premium access for just $49 a year. Join the workshop, put the wheel to work, and start growing your income today.